Welcome to Growth Investing Mastery. This video will look at our July 2025 portfolio review. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to review our growth stock portfolio, and we are building discipline by doing an in-depth examination of our stocks. A superior process will yield superior results in the long run. And this channel is up a remarkable 276% since the start of 2024. Let's now have a look at our allocations. We have three top confidence positions, which are Astera Labs, symbol ALAB at 19.6%, Reddit, symbol RDDT at 16.2%, and AppLovin app at 16%. And then we've got three medium confidence positions. There's Sezzle with symbol SEZL at 13.3%, Hims and Hers Health, Hims at 12.6%, Paymentus with symbol PAY at 9.5%. After that, we've got four low confidence positions. The first one is a new stock, Health and Tech, HIT, at 2.9%. We've got Paysign PAYS at 2.3%, Cineverse CNVS at 2.1%, and Nova NVMI at 2%. Wrapping up our portfolio, we have three starter positions. The first is Dave with symbol DAVE at 1.4%. We've got Powerfleet AIOT at 0.9%, and Credo CRDO at 0.9%. And I ended the month with a little bit of cash of 0.3%, and I was planning to put that in Powerfleet tomorrow. There was one company we sold in the month, which was Champions Oncology, CSBR, and we'll get into the reasons for that sale later in the video. We have two new positions, Health and Tech and Powerfleet. And to create those new positions, we trimmed Credo, Astera Labs, Paysign, and Cineverse. I also added to Paymentus in the month, and I feel like this company is getting very undervalued. We are up to 13 stocks, which is typically more than I would like. In previous videos, I've mentioned I like holding between 7 to 11 stocks. And there is a possibility during earnings season that one or two of our companies may disappoint, and that may provide a natural way to get down to 11 or less stocks. Taking a look at our results for the year, in 2025, we're up 53% year to date, and our cumulative return since January 2024 is 276%. Our year-to-date return in 2025 of 53% is versus the 9% return for the NASDAQ. In this month, Astera Labs had a really strong rally, along with a promising earnings report from Reddit. And you can see on the graph here how crazy big the swings have been this year. We were down quite a lot in March and April, and then it's rocketed back very fast. This channel is looking to prove how strong our process is by delivering consistent results over time. Let's now talk about taking risk to get returns. We are looking for companies which can 3 to 4x in the near term, and we want companies which can 10x over the next couple years. Inherently, these types of companies will have more risk, and we expect to select incorrectly often. And just buying good large cap companies will not get this type of return. Many investors will only invest in well-known names. And a lot of times the reputational risk for someone is too high to recommend a new growth stock. However, on this channel, we realize getting a few multi-baggers per year will drive huge results. And staying inside the box of universally recommended names will not get the type of returns we want. Astera Labs with symbol ALAB is my highest confidence position. They are an AI hardware and software platform for rack level scale. The company gave a lot of hints in their Q1 transcript that Q2 will be strong. First, they said, we expect our Scorpio PCB switches and Aries 6 retimers to shift from pre-production builds to volume production in the late Q2 timeframe. Later, they said, I'm excited to share that we will begin shipping pre-production volumes for Scorpio X Series starting late this quarter. They also said, looking ahead to Q2, we anticipate accelerated shipments of Scorpio P-Series switches and Aries 6 retimers. Lastly, they said bluntly, we expect Scorpio product revenues to grow sequentially in Q2. Another thing I picked up on in their Q1 transcript is they've been emphasizing that general purpose compute is growing. That means non-AI hardware and software sales. They mentioned that multiple hyperscalers are designing the gearbox into both AI and general purpose compute platforms. And one analyst noted there's increased product diversification. Management mentioned about their Scorpio X series that it's an anchor socket with greenfield TAM. And it's always great to see if a company is talking about greenfield TAM where they're the first one to market on a product. Astera Labs is reporting earnings on Tuesday, August 5th after market close, and I'm expecting a big result from them. Our next high confidence position is AppLovin with symbol App. They are an ad tech platform in gaming, and recently they're expanding to web. On their Q1 earnings report, they said they revived an industry talking about gaming, and they also mentioned partners are vocal about support this quarter. So that's really good to see that their customers are enthusiastic about AppLovin and they're promoting it in a way. This upcoming earnings report will be the first earnings report after they sold their gaming business. And one of the key product developments to follow is their web pilot. They're developing a self-service dashboard. And in the Q1 transcript, they said, we're developing a self-service dashboard and we'll be launching it this quarter for select customers. However, they did add later, it will take a few quarters to refine these tools for a broader release. And I had actually missed that part on the first read through of this transcript, that it's going to take a few quarters before the general release. But it sounds like they're working on the self-service dashboard with some select clients right now. The company sees alternative payments in the Apple App Store as beneficial. They called this fee relief. And if the gaming companies can save money on fees, that's more money they can put back into marketing. Taking a look at some of the incredible numbers that AppLovin is producing, they have 4 million adjusted EBITDA per employee at the run rate level. And last quarter, they gained 600 basis points of EBITDA margin quarter over quarter. Additionally, the quarter had 113% year-over-year growth in free cash flow. The company is aiming for zero churn on their web pilot, and they mentioned currently they have about 3% churn on their web pilot, which they consider unacceptable. It sounds like the CEO is adamant that they're going to get churn down to zero before releasing the self-service dashboard generally. One thing I found interesting from the Q1 transcript review was they compared themselves to Meta. And with Meta, you select what audience you want. But with AppLovin, they said they're not divvying up audiences, and they match up against the model automatically. So it's a more seamless process for advertisers. Additionally, they added about the web pilot. They can flip a switch to make the web pilot go global. Currently, it's only US based right now. AppLovin is reporting earnings on Wednesday, August 6th. And I'm also expecting a big result from them as well. Let's now take a look at another high confidence position, which is Reddit with symbol RDDT. They are social media, which is based around community, and they just reported earnings on July 31st after market close. The company had guided for 410 to 430 million of revenue in Q2, and it landed all the way at 500 million. I had guessed they may come in around 445 million for revenue, so they even beat my guess by 55 million, which is quite a lot. Additionally, adjusted EBITDA was guided for 110 to 130 million, and that landed at 167 million. Also a very strong beat on profitability. The company's upcoming guide for Q3 on revenue was 535 to 545 million, which would be plus 43% at the top end of the guide, and adjusted EBITDA was guided for 185 to 195 million. Gross margin came in quite strong at 90.8%, which is up 130 basis points year over year, and daily active users was up 21% year over year, with weekly active users being up 22% year over year. Those user growth numbers aren't that strong, but it's encouraging to see that the company is getting more profit out of each user. One thing I noticed from the press release, which was a bit of a concern, is that other revenue was 35 million, plus 24% year over year. And other revenue contains data licensing deals. And part of my thesis for Reddit was they'll be able to license out their data. But this segment of the business doesn't seem to be growing as fast as I thought, while the advertising business is growing faster than I thought. And so I've only looked at the press release so far and haven't reviewed the earnings in depth. So I'm going to take a closer look at the transcript and get into the earnings a bit more, but I didn't have time to include that in this video. The company Sezzle, with symbol SEZL, is a high confidence position. They are a buy now, pay later solution with a loyal customer base. And management said the sector will gain share as they take share within the sector. The company has mentioned buy now, pay later is aligned with responsible payment, and customers must be current to continue on the Sezzle platform. The web bank partnership has been driving results with its unified fee structure. And this company is simply putting up incredible numbers. They mention on a rule of 40, the company measures 200, and net income margin was 34.5%, with adjusted EBITDA margin of 49%. Keeping in mind, these margins are much better than their bigger competitors like Affirm and Klarna. The company mentioned the funnel is great, and there's more focus on enterprise-level merchants now. New categories, which buy now, pay later was late in, are starting to be adopted now. And buy now, pay later is becoming more mainstream. The company has a new feature called auto couponing, and it's a great surprise to the consumer when they get a free coupon that they weren't expecting. And that coupon is auto applied, so they automatically save money without having to do anything. I have two big concerns for this business. The first is, with the web bank partnership fully implemented, can the growth rate continue? And the second is that their mod subscriber number was up 77% year over year, but down quarter over quarter. I understand it's some seasonality, but it doesn't seem like seasonality would account for that full decline. So I'm still a bit unsure on this metric and how that works. And this stock is really a numbers stock for me. It's got really, really compelling numbers. I'm not too thrilled about the story with buy now, pay later, but I'm willing to keep the position as a top position while they continue to put up great numbers. And again, this is another company reporting earnings next week on Thursday, August 7th. So I'm excited to see where Sezzle can land. Hims and Hers Health, with symbol HIMS, is a high confidence position. They are a telehealth provider offering personalizations within medicine. The company has been emphasizing that lab diagnostics, blood tests, and growing data sets are giving them a competitive advantage. Acquiring a peptide facility is expected to be a vital component of their strategy moving forward. The company's been mentioning a few things on the international front. First, they said they're seeing early traction in the UK. And recently, they gained permission to offer compounded GLPs in Canada after Novo did not file extension for their patent. Adjusted EBITDA margin was up 400 basis points quarter over quarter in Q1. And HIM's nationwide internal fulfillment is going from an area of 400 square feet to 700 square feet, as they've acquired some new facilities where they can produce products. The underlying components are sourced from the US, and they're compliant with good manufacturing processes, along with working with the FDA hand in hand. I caught this quote I like from the Q1 earnings transcript, which is, "We aim in all our ventures to be extremely blue chip and play by the rules." They mention the rules are straightforward and clear on compounding. And it doesn't seem like they're going to be breaking the rules or doing something unethical. I caught one more interesting stat in the Q1 report, which is that oral weight loss is growing 300% year over year. And there's already generic options there, so there's no risk of pharma companies getting upset. Hims reports earnings on Monday, August 4th, and I'm optimistic about what they're about to report. Our last high confidence position is Paymentus, with symbol PAY. They are a SaaS payment collection platform for enterprises, and the price has been drifting lower despite the recent market rally. The company seems relatively unknown amongst the investor class for some reason, but the numbers the company puts up continue to be very impressive. Adjusted EBITDA margin in Q1 was a record 34.2%, and on a Rule of 40 basis, the company comes in at 61. Paymentus has zero debt and an increasing cash balance of around $250 million. They added roughly $40 million to their cash balance, just from operations on the latest quarter. Management mentioned in Q1, large customers are scaling beyond what Paymentus and the customer thought was possible. My top concerns for Paymentus are that transaction volume was up 28% year over year, and adjusted gross profit was up only 26% year over year. However, profit per transaction is increasing as Paymentus is onboarding larger customers who typically have larger bill amounts to their customers. The valuation of Paymentus is incredibly attractive. There's a PS ratio of 3.2, and that's a bargain for a SaaS company that's growing revenue 48% year over year. And I wrote here, our patience is unlimited as long as the company delivers results. And we're willing to wait as long as it takes for the market to catch up to the opportunity here. And a mistake I see a lot of times is when a company is not moving for a few quarters, people will often sell it, even if the results the company is producing are strong. Paymentus is reporting earnings on Monday, August 4th, and we'll see what type of numbers they can put up here. I'm expecting this stock to rally significantly after they report, but we'll see where they land. Cineverse, with symbol CNVS, is a low confidence position. They are a movies and series distribution platform. I was surprised to see this company is scheduled to report earnings again on August 13th, and they just reported earnings on June 27th. So this is a really confusing fiscal calendar they have, and I need to look into this issue a bit more to understand what months they're actually reporting on here. On the June 27th report, the revenue numbers were a slight beat and a little bit lower than I was expecting. However, adjusted EBITDA was way ahead of analyst expectations and my expectations. Because of the profitability coming in much higher than expected, that was okay to offset the lower revenue number. As far as momentum for this business, new movie releases are not happening until August. So I'm not really expecting any groundbreaking news in this upcoming report, but we'll see what they say on it. And I'd really like to see that profitability trend continuing in this latest report. That will allow this company to build their cash balance, even when they're not producing hit movies. One new position this month is a company called Health and Tech, with symbol HIT. They are a B2B platform for small businesses to get customized healthcare plans. I posted an introductory write-up on Salesboard, which is a great place to discuss growth stocks, and I'll include a link to that write-up in the video description. Also, I wanted to give a shout out to my listeners coming over to the channel from Salesboard. And that long-form introduction got a really encouraging response from the board over there. Getting into some company details, this is an 80-employee company with a $100 million market cap, so it's a really small company. In this latest quarter, revenue jumped 86% year over year to 9.3 million. In the B2B space, the number of brokers is growing and expanding, and there's a symbiotic relationship where the brokers profit from bringing in more clients to health and tech. And this business helps other small businesses a ton. They can get that customized healthcare plan they really want and they can even take insurance if they're worried about some catastrophic injury or a long-term condition for one of their employees. The company says speed is key, and a response the same day is where other legacy providers take weeks. So, for example, if a small business wants to get healthcare, typically they would reach out to somewhere like Aetna or Blue Cross Blue Shield. And those companies, those insurance companies, would gather information from them, and it would take 2 weeks to get a quote back. But now health and tech can do this process very fast and get a better price. There were a lot of hints at Q3 strength in the latest report, and they even had a big deal landing on July 1st, which is the first day in Q3. The company's also been hinting that significant product launches are coming soon, and the CFO mentioned, keep a close eye on our press releases. That's really promising when a company says they have some big news right around the corner, but they did mention they don't want to jinx it before everything's finalized. Our next company is Paysign, with symbol PAYS. They are a low confidence position. Paysign's product is fintech solutions for pharma businesses. And I wrote here, this company is really a tale of two cities. Their patient affordability business is up 261% year over year to 8.6 million. But the plasma donor cards business is down 9% year over year to 9.4 million. The reason the plasma business is down is because there's a lot of surpluses in supply of plasma, and companies such as ADMA Biologics got improved collections, so they have a surplus of plasma supply right now. Gross margin for Paysign in the latest quarter of Q1 was 62.9%, and that's up from 52.6% a year ago, as the patient affordability business has better margins than the plasma business. One direct quote was, "We believe patient affordability revenue will more than double in 2025. And that sounds really promising. Yet guidance and analyst estimates are for 3 straight flat quarters in a row. The projections that analysts have are 19 million of revenue and 4 million of adjusted EBITDA for each of the every 3 quarters going forward. However, we'll be looking on this channel for sequential revenue gains to want to continue holding this stock, and I believe the guidance is heavily sandbagged from management, but we'll see about that outcome. And this stock's really been overperforming for the portfolio. It's up 148% in just 2.5 months of holding. Paysign is another company reporting earnings next week on Tuesday, August 5th, so we'll have a lot of updates after this earnings season. Let's now talk about Nova with symbol NVMI. They are a low confidence position, and they are a semiconductor supplier for measurements and diagnostics. I noted here that GAAP EPS was up 56% year over year, growing ahead of revenue at 50%. So profitability is growing slightly faster than revenue, which is encouraging. They mention in the Q1 transcript the Gartner market share report is helping build their reputation in the industry. Demand from AI is driving results with new customers joining the ranks. And there were record sales all across the board. They mentioned there's record sales in standalone solutions driven by their Prism platform and record sales of integrated metrology. The software business achieved record performance as well, but they're not breaking out software revenue yet, and I would like to get a better sense of what their software revenue percentage is. The company is accumulating cash with 820 million of cash on the balance sheet, and that's with respect to a 7.7 billion market cap. The guidance for the next quarter is somewhat weak. It's projecting a sequentially flat quarter. However, I am expecting a beat. And Nova will be reporting earnings Thursday, August 7th in the pre-market. So we'll see what type of results they're able to achieve. Dave Inc. with symbol DAVE is a starter position. The product is an alternative banking membership-based platform. And recently the company got double-digit gains in average revenue per user, which is up 29% year over year. Adjusted EBITDA in Q1 grew 235% to 44.2 million. There was a new fee structure implemented for extra cash, and 60% of originations are on the new fee model, and the full benefit will be felt in Q2. That's a really promising sign for Q2. The company did mention uncertain macro acts as a tailwind for the company because there's fewer credit alternatives. My two big concerns are members grew 15% year over year, which is pretty low, and there is litigation with the Department of Justice regarding some of their marketing practices. However, the DOJ issue seems to be working towards a resolution, and I don't expect it to have a major impact on the financials for Dave. This company, like many of our others, is reporting earnings next week on Wednesday, August 6th in the pre-market. The next company we own is Powerfleet with symbol AIOT. Their product is for tracking of physical real-world objects, and they're a SaaS company and a competitor to Samsara. This company is a result of three separate businesses merging together, and it's a bit more of a complex story than we typically look for. The company did take on debt and dilution to form the new company, made up of the three smaller companies. And they've only been this bigger company for 2 quarters, so they don't have apples to apples comparisons on year over year comps. Yet, despite all this, there's a whole lot I like about this business. They recently got ranked higher than Samsara on innovation by ABI Research, and also ahead of Geotab, which is another competitor. The company has a $550 million market cap, and the fact that they're able to compete with Samsara already is really promising for this company. Their total portfolio of products and where they've landed makes them have landed at over half the Fortune 500 already, and there's a lot of room for cross-sell and upsell. Some surprising stats from the Q1 report was that AI video pipeline is up 120% quarter over quarter, and data highway pipeline is up 50% quarter over quarter. That's in addition to new logo pipeline being up 121% quarter over quarter. But the issue with these pipeline numbers is we don't know what base they are coming off of. And since the new company just got formed, it might be really easy to have these big quarter over quarter numbers. So I'm not sure if this is real growth or if they're just ramping up again. They did mention on the call they're building the muscle for landing multiple 100K plus ARR deals in a given quarter. And the fact that this is just a $550 million market cap and they're landing these 100K deals multiple per quarter is really encouraging so far. I wrote here that management's saying all the right things. They're reducing costs, consolidating, cross-selling, and upselling. And I felt that management was really clear communicating to the investors. So I think they're doing a good job so far. There are a lot of cons for this business, and I've pointed out a few. They did take debt and dilution to build the new company, and it could end up being a Frankenstein business when you smash 3 companies together and hope it all works out. But that's not the sense I get from management, although there's no apples to apples comparisons on numbers yet. I do find the valuation of this company is extremely cheap at $550 million of market cap. I don't really see any reason this couldn't be a $3 billion company. And they did give pretty weak guidance, which is basically flat for the rest of the year. I feel because they just did this merger, they're being kind of hyper conservative. But even hitting the revenue guide for the year would give them a price to sales of 1.4 times. And that's when Samsara trades at 15x of price to sales. So just using that industry comparison, we can see how cheap this company is. Our final low confidence position is Credo with symbol CRDO. And they are a next-gen AI hardware provider, pivoting to more of a platform play. The last quarterly report showed incredible growth. Revenue was up 26% quarter over quarter and 180% year over year. However, I'm still on the fence about this company, and I've really been struggling with how to think about this company because I see a lot of strong pros, but also a lot of strong cons with this business. So the growth is obviously great, but I do have significant concerns. I still think I'm likely to add to them before earnings because I think they're going to have a strong earnings. They're also going against a really easy comp of 60 million revenue last year. And their new guide is for 185 to 195 million of revenue. So even if they just make their guidance, the revenue should be up over 200% year over year. But the cons or drawbacks I see in this business are quite large from my perspective. The first is that the headquarters is in the Cayman Islands. Secondly, they have a customer concentration of 61% in Amazon. While AWS or Amazon is one of the best customers a company like Credo could have, it does give Amazon a ton of leverage over Credo's business. I also feel that the CEO is doing an extremely poor job communicating with investors. 2 quarters ago, he never warned about the customer concentration, and then they reported that almost all the revenue growth was coming from Amazon, where they had 87% of revenue coming from Amazon a couple quarters ago. Additionally, on this latest conference call, the CEO mentioned their software platform Prism. And I never heard them mention this platform before, and I was really confused because he didn't give any introduction about the platform. And he talked about Prism as if everybody was familiar with it. And the really bizarre thing was they released Prism back in May of 2025. And when they were reporting in June, they were talking about it as if Prism's always existed. So it's just really bizarre behavior from the CEO. And I don't like it at all. So that is a con I'm looking at here. Overall, like I said, the growth is just so strong in this business that I want a piece of it, even if there's all these drawbacks that I see. So we'll continue holding and possibly add going into the next earnings, which is in September. So they report a little bit later. There was one company we sold in this past month, which was Champions Oncology with symbol CSBR. This company reported well before I was expecting. And my data provider said that Champions Oncology would report earnings on September 9th, but they reported earnings in late July, so I was scrambling a bit to check in on the press release. In the previous quarter, Champions Oncology had signed a $4.5 million data deal, and almost all that revenue went straight to net income, so it was a pure 100% profit on selling that data. And during the question and answer session, one analyst was able to get out of management that there was 2 to 3 deals in the pipeline. However, they never mentioned the size of the deals, and that was always my big question mark around this business. Would the deals continue to be around that $5 million range, or would they be bigger or smaller? And it was a huge disappointment to see that in this quarter, they only signed one deal, which was for $200,000 only. And to put that in perspective, the new deal is less than 1/20th of the size of the original deal. Management never warned that there would be tiny deals or that the deals would be much smaller. With the first deal being at 4.5 million, you would expect other deals to be similar in size, or at least have management call that out. Additionally, the main part of the business for Champions Oncology is not growing. This company was a clear sell based on the information, as the numbers are no longer accelerating. And I was pleased to get a clear signal like this, so it was a very easy decision after seeing the report. And even though this business felt like a big disappointment, it was a 15% gainer in just 1.5 months. And if you average that out for a CAGR return, it's actually an incredible 206% in the year. I had to double check those numbers a few times, but it does work out to be a very big gain if you're getting 15% every 1.5 months and rolling that forward. So it's just something to keep in mind that sometimes companies which feel like a disappointment can actually provide some returns for our portfolio. Now let's take a look at some promising new stock ideas. And this section is renamed from research if you previously watched my other monthly summaries. And the idea here is to indicate a bit more. These ideas are filtered for showing promise of companies I may want to invest in the future. There's a company called GeneDx with symbol WGS. They're a genome-based diagnostic testing company. And I used to own this company about 6 months ago. They just reported earnings and revenues growing 49% year over year with increased selling prices. and there's a lot of traction in the NICU for their product. It's promising that OpEx is going down and gross margins are rising. My main concern is that testing volume grew 28% year over year, and I'm not sure that price raises are sustainable in the long term, although they are adding more indications and tests for their product. Another company I looked at was Evolve Technologies with symbol EVLV, and they are AI-based metal detector. I had highlighted this company in a previous video where I was talking about evaluating a new company, and I thought this company showed promise, but I ultimately ended up passing on investing here. Revenue grew 44% year over year, and they've transitioned to a subscription model, which includes software plus support. They've been landing at schools and hospitals, which seem like really stable customers who are very unlikely to churn on the product. However, I did discover there's some red flags for this business. There's an all-new C-suite. That included the CEO being replaced, the CFO, along with maybe 5 or 6 other top-level positions. And it really made me question what's going on there. Sometimes having new management can reinvigorate a company, but on balance, having all those executives leave is usually a bad sign. Additionally, there was an FTC lawsuit against Evolve Technologies saying they made false claims about their product, and they were overselling the AI component. It seems like that dated back to 2023 and it might be resolved now, but it did sound kind of murky about whether that's reaching a final completion or not, so I'm holding off on investing here. Let's now take a look at 3 more promising ideas I discovered in the month. The first is IREN Limited with symbol IREN, and they are a Bitcoin miner that's transitioning to high performance computing. So they're going to be competing with companies like CoreWeave and Nebius, which are renting out high performance compute. Currently, they have 172% revenue growth and they're GAAP profitable. And one crazy thing about them is they can produce a Bitcoin for $44,000 currently. With Bitcoin being around 120,000, they have a very high margin for their business right now. A lot of their projections for revenue and profitability were assuming a Bitcoin price below 100K. So they're likely to beat their projections by a lot. And something about this business is they don't hold any Bitcoin on the balance sheet. They sell it all back to the market right away. And they have the lowest cost to produce a Bitcoin of any public company because they use purely renewable energy. They own the land and they have low procurement costs. The high performance compute only makes up 5% of revenue, and they want to do a big transition there. But I'd first like to see that business model proven and show they can maintain these high profit margins moving into that high performance compute. I do feel this company is flying under the radar compared to Nebius and CoreWeave, which everybody's talking about. So I think IREN's going to sneak up on those companies pretty fast. The next company we looked at was Jefferson Capital with symbol JCAP, and they are a debt recovery service that just IPO'd this year. Revenue is $151 million, which was up 51% year over year, and they have a staggering $92 million of EBITDA with a net income of $62 million. The market cap is $1.1 billion. The company is expanding in the UK, Canada, and Latin America, but a lot of that expansion is through acquisition. One con I saw with this business was they outsourced a lot of operations to India, and I'm not sure how that'll play out, but I'd like to wait to see the first earnings report post-IPO before continuing to look at this business. Most of their competitors are not growing, and it's interesting to me what innovation they're bringing to the market. So that's something I would want to look into a bit more. What's their competitive advantage? The last company we looked at is called Innoviz with symbol INVZ, and their product is LiDAR and perception software based out of Israel. Revenue is still pretty small at 17.4 million, but that's up 146% year over year and 190% quarter over quarter. They have a whole lot of wins in the auto industry, and one they were calling out was the VW electric minibus, which is equipped with 9 sensors from Innoviz. My big concern is that they guided flat for the year, and the huge ramp they're expecting starts in 2026 for most projects. But I do want to keep this company on a watch list, and they'll be reporting soon as well. So I definitely want to check in on the numbers this company can put up. Now let's wrap up with some concluding thoughts. We are getting into earnings season next week, and there's likely to be some portfolio shakeups. I wanted to mention too that I started a Twitter account, and it's at GI Mastery, which is Growth Investing Mastery. I couldn't get that full handle, so it's at GI Mastery. So give me a follow over there if you can, and I'm likely to post some new stock trades as they happen through that platform. And I've currently got 4 ideas for some upcoming videos. The first one is how to use AI for growth investing. So I'll look at some good use cases and also some mistakes with using AI. I also want to do a video called Investing Without Fear, and I haven't done a psychology video in a while. The market's mostly been going up, but I would like to get back into that topic a little bit. I'm looking to do a video about defining our process or defining anybody's investing process and how a person can make improvements building their process. And lastly, I'd like to do a video on select earnings reports, especially companies I own which are outperforming, and I'd like to bring them to your attention. Also, let me know in the comments section if there's any topics you'd really like to see for videos regarding growth investing. This concludes the video, and give me a like or subscribe below if you enjoyed the video. As a final reminder, this is not investment advice or recommendations to buy stocks. Thank you.